Fenton.
Witten, how are you?
Good, mate. Mate, well, there you go. Hey, a little bit of technical delays, folks.
But we got there in the end.
Yep. Well, I don't know. It seems a bit delayed now, Fenton. So maybe, maybe, hopefully it'll catch up. Anyway, folks, welcome along. Good to have you here. You're not here yet, but some of you are. Give us a shout out in the chat when you show up. We've been trying to work out Andy's tech. He's in a new spot. You can see his fancy, very nice and fancy background there. Yep, it's very flash. He's in his new office in his new studio with his new equipment, making sure we're getting it right, mate. How you doing? What's going on?
Mate, well, apart from getting this set up for tonight, and I think there's a little bit of a delay, but we'll hopefully manage it pretty well. But, mate, other than that...
You're looking pretty good now. You're looking pretty good, mate. Go for it. Yeah.
Thank you, mate. Well, I've just cracked open a beautiful bottle of wine that's actually made by a couple of friends of ours. No longer made. Manton's Creek was the name. It's a Tempranillo. It's 2004. So we'll see whether we can make a dent in that tonight. No doubt I will, and hopefully it's still reasonable. It hasn't turned to vinegar yet. Have you got the 9 Popes out, mate?
No, mate. I'm sticking with the Alicante Bouquet. Anyway, the reason I'm drinking this is because I can drink a little bit of it and I can put it back in the fridge, Andy. Like,
as long as it's not for a couple of weeks.
That's exactly it. Yeah. Well, welcome, folks. Good to have all of you on. Give us a shout out in the chat. I can see a fair few of you guys on right now. Welcome to another Wealth, Wine and Wisdom. Another Friday, Fenton. Another week gone by. Folks, most of you know this, but if you don't, we've been doing this for a little while. And, we try and follow a little bit of a structure, Andy, but often we get a bit waylaid with conversations and commentary, but usually we try and sort of do a little bit of a debrief, folks. What's in the news? What's out there? What's topical? Things you should know. We need to learn a few things, and hopefully we've got something to teach. And along the way, you might have some questions, and if you do, make sure you put them in the chat, folks. We would love to answer your questions if you have some, or comments or observations, whatever they are. And we'll get into it. But Andy, we've been doing this for a while now.
Yeah, 2.5 years, 3 years, 3 years.
Yeah, I think we're rolling into the third year of this stuff, and we've had a few iterations of what we've been up to. Hey, Sharon, good to see you. Awesome to have you on tonight, Alison. As always, great to see you. But yeah, we've been debriefing the week for almost 3 years now when it comes to what's going on out there in the marketplace, the weird and wonderful world of opinionations. I don't even know if that's the right word, but we'll make it up. Opinionations of often inexperienced and misguided media when it comes to actual factual reporting. So Andy and I thought we'd set the world straight, one little bit of information at a time, and we're starting our own backyard, which is Australia. So anyway, that's where the wine and wisdom world has come from, the wealth, wine and wisdom. And, we try and sort of make a bit of sense, folks. So good to see all of you guys here. And welcome to another afternoon conversation about what is going on, mate. So listen, in the world of finance and banking and the world of the share market, Andy Fenton, absolute legend, extraordinaire, 20 plus years in that world. Myself in the real estate and investing game on that side of the fence, 20 plus years, and along the way, Andy and I have skinned our knuckles and our knees once or twice. And also, we've done a few things that have ended up working out pretty nicely. So we've got a bit of experience personally. We've helped thousands, and I'm saying thousands and thousands of people in business, investing, So we like to share a little bit of the wisdom. Andy, did I miss anything? I think that was about it. A little
I
rant.
think it was a pretty good summary. But I can't wait to get into a few things here tonight because there's. I know that you've already picked up on stuff in and around your world, but I've seen some headlines that you picked and you called it around about. I reckon every wine and wisdom for about the last 6 months. You've been banding on about something that has come to fruition. Part of our headline, ladies and gentlemen, and you go back probably every episode for the last 6 months to 12 months. You'll have heard Jason waxing lyrical about one of the things that I'm sure is in the news, and I've got a few things to chat about that's offshore. I thought we'd have a little bit of a look-see at America, maybe have a little bit of a chat about why America isn't Australia. And I think that a lot of Australians are pretty glad about that. But
yes.
But also because we see what happens over in the States. And right now, mate, the media is well and truly focused on America recession. They're talking technical recession versus normal recession versus the politicians saying, "What's a recession?" It's a bit of
It's a fake recession, Fenton. It's a fake recession.
Yeah, mate. I think these guys just jump into the dictionary and just start tampering with it. It's quite incredible. But I thought I'd chat a little bit about America this time around. So for those of you who are keen to understand what's happening in the States, maybe you've got some stocks in Google's or whatever it might be, but have a chat about that and show you why it's actually not Australia and why it's very, very different to Australia and what's actually happening out here. But Jace, one of the things that's very similar in America, which I don't have slides on, which I'll probably go to get over the coming weeks, is mate, the property side of the equation is very similar as to what's happening in America to what's actually happening out here. Different reasons, some of the same sorts of stimulus, but yeah, it's is America a part of Mexico? I think Jeff just put it up there. And Mexico. So sorry, Jeff, North America.
North America,
the correct way of saying it. But so that's a little bit of what's in my world, and also got some stuff in and around interest rates, which might be interesting for some of the mortgage lovers out there, mortgage lovers or mortgage holders, or what's happening with mortgages. Are we going to 22% interest rates, or are we going to be plateauing? And Jace, I think you've got some interesting insights as well into what's actually happening at the bank level, which is going to be super interesting. So stay tuned, folks. We've got the big US we'll chat about, and we're going to talk about interest rates and what mortgage rates are doing, and then have a bit of fun in between it. So whack the questions in now if you've got any questions, especially around those topics, and we'll do our best to get to them as we go through. But mate, interested to see whether I was right in what you have picked up from in the news this week. What have you got?
Well, mate, I think, folks, unless you've been living under a rock, there's plenty of interesting things going on, Andy. And, we are seeing some very interesting stats when it comes to the rises in rents. And it's only the beginning, Andy, folks. I've been saying it for a long time. It takes time for lease renewals to flow through, and really right now, in the past, Andy, folks listening in the past, prior to, I just dropped my pen. I'll be back.
Well, that makes sense, doesn't it? Because most leases on properties in the non-commercial, in the residential space, most people, unless they've been listening to us, Jace, or more specifically you in this domain, have yearly rentals. So if you've just signed a rental contract with one of your tenants last month, well, it's going to take 12 months for you to raise that rent again. You can't just willy-nilly raise the rent. So these types of changes will be coming through for the next 12 months, likely.
Well, and you see, Melbourne apartments rents jumped 34%. I talked about that for ages, Andy. The apartment space was depressed in Melbourne for a while. And, I said it's going to make a comeback, team. You watch this space. Also, folks, Andy, what happens, prior to, 2021, we all still had very low interest rates, Andy, even though the supply was low, even though vacancy rates in 2021 were like some of the lowest we'd ever seen in history in Australia in some of these places. there was actually no motivation on behalf of the owner of the property to put the rents up. Like there was no pain. As soon as the interest rates have gone up, then everyone's gone, oh my lord, what's my costs are going up. And now you will
mean
see
I actually
that.
have to pay for this property myself?
Yeah.
No,
What do
that's
you
not
mean
going
I'm
to
not going
happen.
to get a 2% interest rate for the rest of my life? Are you kidding me? So, that's where this is coming from. And it's going to come fast and furiously. And I've got a couple of stats to show you guys in a minute. So stick with us, folks, about mean reversion, Andy. You've talked about this before. Like I've heard it a number of times. The rental market mean reversion is only just getting started, right? Because if we have a look, Australia's rental crisis, record price hikes, etc., it's going on right now because the interest rates are coming up. And my prediction, it's going to take sort of 9 to 12 months to flow through, Andy, as you go. And, we're going to see some interesting things. Oh, I thought this was actually funny. Andy usually has a bit of a joke.
That's a very curious drawing, Jason.
It is a bit of a weird drawing. However, gosh, right to the commentary, Andy. People sitting around going, "Oh, I hope the marketplace collapses." Well, it's not going to collapse. There might be some short-term rearrangement of people who have, badly planned themselves. There we go. Andrew. It's interesting, Andy. You and I. And I've been saying it elsewhere too, but you and I have been talking about put your rents up, folks. And I've been saying it for well over 12 months. We are in the middle of a rental crisis. Get them going. And the problem is, interest rates can go up. Tell me in the chat, folks. Tell me in the chat right now, how fast can your interest rates go up? Put it in the chat, okay? Like, what's the time duration between interest rate increases? Put that in the chat for me for a second. So it's a little lesson here. Hey, Kylie, good to see you. And maybe let us know what you're having tonight. Looks like Kylie might be having a glass of champers. But tell me, yeah, once a month, right? Once a month. So Alison is dead right, folks. So listen to this, month by month, right? So your expenses, listen, your expenses are going to go up month by month, or they could go up month by month, right? How often can you, by the law, put your rents up? And it's actually tightening up right now. So your expenses could go up monthly, but how often could you put your income up in your oh no. Kylie's working tonight, so she's on the Windex. All right, well, fair enough. Kylie, don't get
I used to drink Windex just when I had the desire to take my clothes off and run down the street. Apparently, Windex prevents streaking.
Well, there, Fenton, boom. There you go. I need a sound effect for that one. Well, there you go. Look, so listen, Melinda's got it. Andrew said end of a lease. Melinda says once a year. Folks, that's right. Your cost could go up often. Oh man, my tech's playing up, Andy. Your cost could go up monthly, but you can't pass on, the offset. And that's why I'm sort of talking, to all of our crew, Andy, about, listen, get on with it, folks. If your lease is coming up for renewal, don't miss this, because if you lock it away and you miss it, your expenses could go up. They won't, but they could go up 12 times in the next 12 months before you could even hope to offset the expense, right? So for all of us, that's important.
Look, if you've been listening for a little while, then you've probably already done it. Jace, I had chatted with some new clients with substantial property portfolios just recently, and I looked at the yields on them, and I'm like, oh, these must be dog properties. And then I sort of begged the question. I said, so when was the last time you did a rental increase? And the question was, oh, what? And And sure enough, mate, as I did a quick Google search for 4-bedroom houses in the same suburb, I was like, well, hang on, here. All right, well, we've just made you a lot of money. Because
Yes.
the agents who were doing the rental agents for them, who were doing it all for them, never asked, never said anything, never said boo. They didn't care.
Well, and the reality is, unless it's an agent who cares about their business reputation, which most don't, unfortunately, there's no real motivation, Andy, for that agent dollar-wise to go to all the trouble to help you get a $50, $100 increase, because they're only going to get paid like $2 to do it. Now,
Well, if they want more clients and lots of them, or maybe want to charge more rates, and I know that you have an arm, that does this for your clients, but you also provide this on the other side of the equation, mate.
Yeah.
But I reckon I'd pay twice as much for an agent that's going to keep me up to date with what the rental yields need to be, and constantly adjusting who's going to be doing. I think that sometimes people just get lazy.
Yes.
At the way that they do business, and stop looking for the opportunity to provide better value.
Mate, you and I agree with that. Like we're many businesses don't necessarily follow through on what they should. That is for sure. But let's have a quick look at this one, Andy. We were talking about that mean reversion. Oh, it's playing up on me. I don't know. There you go. We're having a bit of an issue here, team, but hopefully it won't glitch out on me. So, Andy, this is
I was the problem child when it started, and now it's flipped around, Dave.
So if you look in here, I scroll in.
Just give us an idea of the timeframes that we're looking at there, Jace. Just down
this
to the
is
bottom.
kind of 2010, right down here. So if we sort of squidge in, and this is 2020. That's kind of
right.
Yep. So if we scroll in, it kind of went down, flat, and has gone back up, right? And we're kind of down at sort of 2022.
What are we looking at there, Jace? What are the different lines? I can't see the legend.
They're all houses, like all houses, 3-bedroom houses, all units, 2-bedroom units, and combined. So in essence, what happens if you look at kind of the mean reversion of kind of different stock choices right now, it went down, and it's just sort of cracking through where it was 3 years ago, Andy. Right, so it's going to sort of catch up, across the board. Now, this is an aggregation of the whole of Australia. If you drill in using this research tool, which is SQM Research, which is an amazing tool, folks, if you're ever in the world of doing a bit of research, then you're going to see the mean reversion in places, especially like Melbourne, Andy, not even getting up to the highs that they were 3 years ago. So we've still got a long way to go in places like Melbourne for rent growth, right?
Yeah.
So you'll see that sort of thing, because if you look at a bit more of a shorter term one, sort of Jan 20 to sort of April 22, you can see Melbourne is still low in comparison to where we started. And Sydney's kicked off a bit just because Sydney's a behemoth. But in comparison, Melbourne's still low on the back of a 30+% rent increase, folks. Okay. So, this is the thing. I think Melbourne's got plenty of legs in it. It's still an inexpensive city to rent in comparison to Sydney by many hundreds of dollars. So, that should be pretty good. And the vacancy rates now, Andy, June 21 to June 22,
wow.
Significantly reduced, like insane reductions. And, look at the rest of Australia. The rest of Australia is
as low as where the cash rate was, wasn't it?
Yeah, it's true. Yeah, it's gone the other way around now. But, here's why I'm bullish on Melbourne. We're sort of theming on Melbourne right this second, but every other marketplace is, getting a bit of the action as well. The change in rental listings is a 26% drop in number of rental listings as well in that 12-month period. So Melbourne's kind of coming home strong, right? So some of the other places
So
were
what you're saying there, Jace, is that there's 26% less properties listed for rent in Melbourne now as there was
a
last
year
year.
ago, yeah, at an
Wow.
already all-time low of supply, right?
Wow.
Yep. The challenge with Melbourne is Melbourne's rent, Andy, dropped like $100 on average, where the rest of Australia kind of stayed steady
That's
because of
probably
COVID lockdowns.
Yeah,
Yep.
because
Yeah.
Dan features again. Dan the
Mate,
man. Can't
mate,
get
Dan,
anything
man.
wrong, mate. He
Yeah,
did it
well,
better
there
than
you go,
anybody else.
mate.
He literally we've got the record, mate. Record.
Record
The
breaking.
whole world.
And again, Melbourne being the competitive city it is, 52% change right now in volume change. So anyway, that's why we're ending up with 30% rental increases down there in Melbourne, Andy, and across the board, lots, not much to rent, lots of, lots of challenges for people. And check
And
this out. This is interesting. Affordability in some places as well. If you think about affordability, you know, well, people won't be able to afford to pay a mortgage either. So they're going to turn to rents. Okay.
yeah,
Like, you have a look at this 38% of the average Victorian wage has to go towards mortgages. Check out New South Wales, Andy, 46% of the average earner. So, that's pretty high. It's a lot higher than it was 3 years ago. So, this is going to turn to rents and all sorts of stuff. So,
and
mate,
this was something, mate, that my dad, Tony, if he's listening,
good old Tone. Shout out
if,
to your Tone.
if Margot's listening, she's probably already given us an angry face already for maybe swearing too much. But this is where, mate, and I've been chatting about it a little bit recently because now listening to you over the last couple of years, learning a little bit more about the resi space. He used to say to me that sometimes it's cheaper to buy a house and sometimes it's cheaper to rent a house.
Yep.
And that's the sort of the cycles of the residential property market is that, at over a period of time. So as we're going through that, I mean, I guess the question is, to what extent is that true based on your experience? And then if it's true, where are we in that cycle? And is it true or not? I think is probably
the answer is yes, absolutely true. It's about to turn on folks right now because, Andy, at the same time, property prices have escalated. The cost of a mortgage is escalating. Now rents are going up. So, when the interest rates were very low and before the boom of, the last 2 years, right? There was a sweet spot there. It was actually significantly cheaper to buy and own a piece of real estate than it was to rent.
Yes.
So right now, just depending on what's going to happen in the next little bit, but I think we'll in a fair few of the higher valued cities, Sydney, Melbourne, Brisbane, it's going to be cheaper to rent than it will be to have a mortgage. So, I think that's going to be, and again, that's going to accelerate things, mate. One of the slides I had here, but I won't bring it up right now, but we can just talk about it. There's talk about in the next 10 years, the population increasing, pretty significantly, up to, 29 million people. We're at like 26 now or something like that. I'll pull the right number up and I'll grab it out. But, where are they going to live, Andy? Like, because right now our construction system. Oh, there we go. So, 5.4 million people in Sydney, go to 6 million, 5.2 in Melbourne, go to 6.1 million. The supply chain, the construction supply chain is going to take 3 to 5 years to recover from today. If you're lucky, even to get back to what it used to be or could be, right? And we still haven't seen the knock-on effect, Andy, of the small builder going broke. I was chatting with a number of small builders. Some of the bigger ones have gone down, some of the smarter ones have, managed to get through. But don't underestimate the decimation of that small to medium builder folks in the marketplace right now. The ones you're
Mm.
not hearing of. You're hearing of Privium and whatever. There was an average, and I'm going to grab this stat, an average of like there's 26,000 builders and trades going to leave the industry in the next 12 months um, because of the financial issues in the industry. Like thousands and thousands and thousands of people leaving the industry because they can't make a buck, whatever it was. So, yeah, some crazy numbers out there, man. But
Yeah. You talk about mean reversion. I don't have it here either, but I'll try and find it. They called it the tradie index. And it
yeah,
was
yeah,
the average costs of wages for tradies over the last, I think it was 40 years. And mate, it was like a hockey stick graph. It was just like that, and that's just not possible, not in any field. You cannot have that exponential growth. It's just not possible, and it's not sustainable because the flow-on effects come through to consumers. And
yeah.
right then, that does need to mean revert, because that if it didn't, it just meant that property was always just going to go through the roof and then become unaffordable to a point, mate, where I heard this garbage on, and I won't mention the news show, but it's a very hip news show, but like most, completely full of and and they were talking about something like this. Buying a property in the metaverse versus buying a property in the real world. And I
Yeah,
shit you not,
right.
this was actually on television last night. So people are looking at buying a nice place next to Snoop Dogg, or in these various different metaverse platforms, and the theme was, Jace, and this, mate, cop this. Unbelievable. What trash. What absolute garbage. Like, there's money to be made in this, but this is highly speculative gambling stuff at the moment. But buy a property in the metaverse, because we're never going to be able to afford to buy a property in the real verse, in the universe. Sorry, buy in the metaverse, because we'll never be able to buy one in the universe. And mate, what absolute bloody dribble it was. But because the idea is, well, are you going to sleep in a little sleeping bag and put on your virtual reality headset while you go to sleep and swim in your virtual pool?
Crazy
Mate,
stuff out there, Andy. But what's really interesting though. Let's change gears and maybe talk a little bit about America and stuff like that. Because you know what, the challenge with Australia. You talked about the tradie index, right? And I've talked about this before. Australia is one of the only nations in the world where we are not connected physically to an inexpensive labor force, right? The rest of the world has geographical connections to different economies, and the arbitrage of someone who works with their hands compared to someone who's got a tertiary education is large, massive, Andy. So, but in
huge.
Australia and New Zealand and some of we're the two highest. The difference between an education, and this is not a shot, it's just a fact. It's just you go to uni and get a degree, or you know how to be a carpenter. You know, in most other countries in the world, the difference, your degree as a dentist, let's say, is pretty significantly different. In Australia and New Zealand, the difference is not that far away. And in some cases, it's actually more, right? In different trades and stuff like that. So it's actually quite interesting. Australia is a weird anomaly in that kind of play. But if you think about places like America, you can go to America right now, Andy, and you can go to a nice town and you can buy an amazing house under $100,000. Like everyone in America, if you have a regular job, can move to a reasonably good town and have a regular job and buy a regular house. Like, because why, Andy? Like, we've got the same size country as America, like the physical land mass, right? Because we have the population, because they have the population and the taxpayer base to be able to maintain cities elsewhere. And this is one of Australia's biggest things that's going to hold it back in the future, as far as I'm concerned, is its inability to provide housing and grow its population. Australia needs a bigger population. We've got a massive country and we can't pay enough for our infrastructure.
Mate, it's been on the books for years. You
Yeah.
know what?
Yeah.
What was the old one? Was it Kennett or was it Keating? Was it Keating or Kennett?
One
One for you, one for your wife, and one for Australia.
Oh yeah, no, that was what was the treasurer? Yeah.
Costello.
Yeah, wasn't it Costello's? Was it or what?
It could have been. It would have been something that Pete would have said.
One for you, one for your partner, and one for the country.
One for Australia.
Yeah. Well, there you go.
But it's true, and this is and you know our neighbouring workforce has been South Korea.
Costello, Andy.
But he's a legend. Like he was painted poorly on the way out because he was I reckon probably the best treasurer Australia's ever seen, but he wasn't the best politician Australia's ever seen. I had the beauty of meeting Pete on a number of occasions, and mate, the guy was great, but he just couldn't play the game. And as soon as he put his sights on Howard's like, don't even start. Like, that's like a scrawny little featherweight coming up to Tyson and going, come on,
mate. Yeah, exactly.
He wasn't fit for the political task. But
mate, what's going on over in your neck of the woods? I know there's a bit on your list, but a bit of a shout out to the folks here while Andy gets himself organised. Make sure if you got any questions, folks, put them in the chat.
Put them in now.
Yep. Whack that in there.
I'm pretty sure Nada's clapping because I mentioned Tony and bringing Tony back on. And that's a little bit of chat. Was it Luke last week who said, come on, you boys, you're always talking about bringing on a guest, but you never do it.
Now, shout out to Luke. If you're listening tonight, Luke, we've got a guest booked in for next week.
To talk about the very topic that we talked about. Malcolm's going to come in and blow our minds. I'll be interested to see what wine he's drinking, and he's a real guru of domestic and international markets. So it should be a great week next week. So Luke, we've changed our stripes. But so what's going on in my world? Oh, very little by the looks of it. Oh, there we go. It's up.
There you go. He's back.
He's back. So going to chat a little bit about the US, right? Because there's a lot of chatter around about the US in regards to recession. Basically what's going on, Jace, is for those of you who don't know, a recession is basically 2 quarters of negative GDP. And they call it negative GDP growth, but that's an oxymoron because you can't have negative growth if that is actually counterintuitive to itself, which I find hilarious because it's bandied around everywhere. But it's negative GDP for 2 quarters, which basically means the gross products of a country or of a state, that what they produce goes into negative territory, right? So what they're producing and what they're earning money for goes into a negative territory for 2 cycles. Right. And that's effectively where the US is right now. But the politicians are basically saying, well, it's not really, we're not in recession. Well, you are, based on the definition of what a recession is. But they go, oh, well, it's technically not. Whatever. So
a fake recession, Andy. It's a fake recession.
It's a fake recession. It's like these guys, I mean, when they talk, it's just garbage. It's just so much garbage coming out. And when the media get behind it, they're just as bad. So want to chat at a couple of different things, right? So equity markets, meaning share markets. We're going to talk about the US debt to GDP. We're going to talk about that because there's some really interesting stats I've got here on CPI and the core inflation, like we were talking about previously.
Yes.
Core inflation versus headline inflation. But this is a really interesting one, the Schiller Index, which is this first one here. Oops, I'll bring that back up. Now, the Schiller Index is price to earnings for companies, right? So price to earnings, which is price. What is a company? What are you paying to buy that company? Yeah. Amazon, Google, BHP, so on and so forth, to the forward-looking earnings. How much is that company going to earn in the next 12 months, next 2 years, 5 years, 10 years, right? So what is the future earnings forecast? Now, during COVID, nobody cared in the US about the E. People only cared about the P.
The price, yeah.
price. Nobody
Yeah.
gave a shit what the company was earning. It was all about the price. Absolutely insane. That's why the market took off 80, 90%, 12 months from the big dip of COVID. So what I like to look at is the Schiller PE. Now, the Schiller PE is just, it's a fancy term, right? I think named after the person who invented it, is where you take a 5-year rolling average of your price to earnings, right? So you take out a lot of the day-to-day noise as to what's actually happening. So you've got, in this graph, you've got your rolling 10-year returns per annum, right, on the index, and you've got your Schiller PE, which is your 5-year average price versus earnings. And you can see here the graph over in the US is diving quite significantly, especially when you look. This goes right back to 1950, right? So we're actually sitting around about here. So the expectation is that the PEs on that rolling 5-year basis are actually going to dive. They're going to actually go lower, which
So
actually
earnings per company or earnings across an index going to go down.
Yep. And a couple of reasons for that. Interest rates go up, companies make less money, their earnings go down. And then people spending, when spending curbs, quite often companies on the other side, that their earnings go down.
They're driven often by consumerism, right? Like, you got to spend something, and if your interest rates go up, then you're not going to spend as much.
100%, right? So to me, this is a great opportunity. And so what we should be doing is we should be having a look in the US. Now, quite often these forecasts, they're written by economists. And we all know who are the 3 people that you don't trust? Politicians,
Economists,
journalists, and economists, right?
Economists.
Because they're generally wrong. But this is a great indication to start to look at the US, right? To start to look at things over there, watching these stocks, watching the E, because the E is the important part, right? When we go through periods of time where interest rates are going up, right? What we want to be looking for is earnings. And if earnings of companies are going up, then they're very attractive, because when interest rates are going up, the cost of borrowing is more expensive. So growth companies like technology companies and these people who don't, they're like, oh, we don't have to deliver any returns to investors. Like, what are you, insane? We're a tech company. We're gods. Well, no, you're not, right? Eventually people want earnings, and we're in an earnings cycle right now. I've got no shadow of a doubt. Earnings, cash is king in this concept, Jason. Cash meaning cash flow, revenue.
Cash flow,
king, right? And all business owners who are watching this, you'll know exactly what I'm talking about. He spelt it wrong. He actually spelt it Friday, Jace. It should be Friday there, Mr.
Friday. Good to see you, Jace.
Good evening.
There's a couple of questions for later, Andy, as well. So we've got Andrew talking about, hey, what's the go with this 2.3 or 2 to 3 inflation target, which is probably part of your conversation as well. So we'll chuck that one up there for you, and I've got a rent one to talk about a bit later. So Paul, we'll get on to that one a little bit later. So, mate, I'll
accelerate through. So I thought this is interesting, mate, because over in Australia, we're very similar to America in many ways, and this is one of them, right? Our governments spend more than what we do, right? That's just generally it. Because if you don't make it, Jace, do you care?
No, you don't care, do you?
As business owners, we kind of get it, right? You don't make it, you don't care. So you spend more of it. So let's have a look at this. Household debt, very similar, right? That's the blue here in the US. So what's happened over in the US, not to quite the same extent as Australia. Ours is quite, since sort of COVID, ours came down quite dramatically.
Really low, yeah.
So household debt actually came down significantly. But, a federal debt, Jesus, just spiraled out of control. Now this stuff, for those people who know the story about the GFC was a big debt crisis, and then there was a debt ceiling. Those debt ceilings are on the bottom floor of a 100-story building right now, to give you context. That debt ceiling, that the debt was never allowed to get back in the days of Obamacare. Not
go to the next floor. It's
actually the basement where people are parking their cars and things like that. Like, it's so
plenty to go.
It's gone. And then, so when we have a look at the inflationary side, year on year percentage increase, and we have a look at some of this. So US very much leading the way, Eurozone very much there. China, well, do we really believe what they're putting out there as statistics? No, we don't. We absolutely
It's a
100%.
managed output, Fenton. It's a managed output.
So ultimately, looking at these factors, is America in a recession? Well, yes, they're in a recession right now, technically, based on the definition of it. Now, here's some interesting stuff about consumerism, right? Because ultimately, it's consumers. Because one of the things that drive recessions are consumers. When consumers stop spending,
Yeah.
then they're worried about the future of their money. And so they stop spending. So this is a really interesting one. This was Schroeder's sort of brought this to my attention. I'd never thought about looking at it this way. Google Trends, right? So Google Trends, this is the number of times 100, and what this does, it equals 100 equals peak population, peak popularity. 100 equals peak popularity. So this, I have no idea what that actually means, but basically what's happening, this is Google searches for recession.
Yeah. Wow.
Right.
There you go.
So back in 2008, right, GFC sort of, so we're literally, from a consumerism perspective in the United States, where from the people over there, from a Google perspective, they're at the same population density percentage, right, of people who are worried about America actually slipping into a recession. So this is now starting to become what we call the Google index. So this is what people on the street believe, because we can measure it. Because if you don't know something, Jace, what do?
You Google it. I tell my team all the time, don't ask me, search Google.
Just Google.
Just
One
Google it.
of the pet frustrations, if you're a business owner out there or a manager of people, just give me the hail or a thumbs up emoji if you get exasperated by somebody coming up and asking you something and you turn around and go, you know what? I've got this very interesting technical tool. I think it's pretty new to the market. It's called Google. If you just go and punch that in there, you'll find the answer that you need in a quarter of a second. Give me a thumbs up if you've done that in the last week or so.
Yeah. How do you turn this thing on the computer? Well, you know what? I reckon Google would know that. So just go.
Oh, but the computer's not working. Well, there's this funny thing called a phone.
Oh, connected. You're connected. Search that.
So, mate, then this is more transportable to Australia, and this is what we were talking about last week. So, the headline theme is America in a recession? In my belief, yes, it is. Two quarters, negative GDP. They're in a recession. Are things looking good? I think they're looking good for starting to think about buying in there. Not right now, but if you've held, and you've still got it. But there's some great opportunities, I think, around the corner, because these situations present great opportunities. And that Google index, I reckon that's a cracker to watch out for, because when people are really Googling, should we buy gold? Well, you should probably be buying the other stuff. So this is the inflation data from the US, and this is really, really, really interesting. So we have a look at where we are now, obviously at the right-hand side, and have a look at when we entered COVID. So energy prices actually plummeted. And I remember doing a wine and wisdom with you, Jace, where we were talking about oil and gas, and they just fallen through the floor. People couldn't pay to move it. They were actually paying people ridiculous amounts of money to hold it. They were giving energy away, literally giving energy away. And we made the call right back here, Jace, that people should be looking at energy, and people should be looking at these sorts of stocks and trades and so on and so forth. Not a bad trajectory, mate. Just by the by, over 2 years.
It's a nice one, top to bottom, bottom to top.
But what we're looking at here is this is inflation in the US, right? The 9% figure that we're all hearing about, and the composition of it. We were talking about last week, core versus inflation. Yeah. Right. So core is still significant, right? When we take out the two that are in here, which so the headline is the green. So that's what gets quoted at the Reserve Bank. And for whoever asked the 2% question earlier on, 2 to 3%, that is in the US. They have their own measures, but that's that headline, that purple one, that's what they've got to keep under control. And that's what the Australian Reserve Bank has to keep under control, is that headline inflation. But when we have a look at energy, right, and we have a look at the composition that energy and food takes up. Now let's have a look back. Energy is quite the devil, right? Energy comes up and peaks and troughs through recessions, through wars and economic cycles. But the food inflation is one that's really probably at an all-time high in comparison in comparison to this. We've got this graph going back well before 2011, but this goes down back to wartime, like post-World War II, since we've seen the same sorts of levels.
Wow.
Now, this, we would say, tends to be more transitory based on circumstances. And a large part of this, not all of it, is largely transitory. So if we were to actually strip out that by a substantial margin, we're probably looking more around that sort of 6%.
Yeah.
Now, why do I say that? Is because this stuff will normalize over 1-2 years, right? And this ultimately, so the smart people in the world, which are the corporations, the banks and stuff like that, start to translate this into government bond yields. And this is where this conversation is going to segue back into how much do you pay on your mortgage, right? Because ultimately, what happens is businesses don't look here to make decisions. Businesses look out here. And I'm not talking about on the next graph. I'm talking when Jason and I make a decision in our business, we're looking 12, 24, 3 years, 5 years, 10 years in advance, and we make decisions based off that, right? So that's where the smart decisions are being made right about now. And they're being made based on, well, where do we think these numbers are going to be in 12 months' time? Do we reckon they're going to be up here? Do we reckon they're going to be back down here? Do we reckon they're going to normalize? Like, where do we think that these rates are ultimately going? And mate, I know, and I'm not sure whether you've got anything there in regards to it. I pulled up a couple of things which I'm going to have to go offline to find. But you spoke to me as we were driving today about interest rates. And what we call an inversion of the yield curve, where you're saying that longer term interest rates now are lower than short term interest rates. And this comes into the inflation discussion.
Yeah, in the fixed interest rate space, Andy, and it's really interesting. You brought this, a few wine and wisdoms ago, folks, where Andy said, "Listen, the market's far smarter than an individual. The market aggregates literally thousands and thousands of financial opinions and says, you know what, we're going to buy bonds or something at a certain price, and it's a free market aggregation of knowledge, information, opinions, Andy, right? So basically what the market it did a little while ago, because in Australia anyway, the RBA, got on the bandwagon and said, righto, we better put the cash rate up. And they went pretty hard at it, Andy. They had a little dab at it, and then they went boom, 0.75, and just recently 0.5 or whatever it was.
0.75 was the US. 0.5 was little old Australia. But apparently we were the most aggressive in the world.
Well, yeah, that's right.
According to some journalists.
So then the market reacted and said, oh, well, at least they're getting on with it. Future value of bonds, which then ultimately flow into cash rates and long-term, lending by institutions to then on lend to consumers. Well, that all sort of said, well, we don't think it's going to go so high now. The aggregated opinion decided that certain bonds and certain values were actually not as high as they were a month ago. So what's happened is, that bond rate has reduced. According to the marketplace, they're going to pay less for it rather than higher. And pretty well, like within 30 days, Andy, the 5-year fixed interest rate, folks, has gone from 6% or averaging in the sixes down to 5.5 for a 5-year fixed interest rate. So it went backwards. So interest rates, like fixed interest rates, the 5-year fixed.
What was it? So I'll bring this up. So just as a metric, so a little while ago, what was it?
let's say a month ago, it
Right?
was 6%. If you were going to lock in a 5-year interest rate, it was 6%. And as
Yep.
of today, it flowed through to, August. So in the first week of August, it's now 5.5. So 50 basis points down for a 5-year fixed interest rate. What does
Now, isn't
that
that
mean,
funny?
Andy? That,
Right?
yeah,
Isn't
yeah,
that hilarious? Well, it's not hilarious, but it's interesting, right? Because one would say that you'd think that the banks, oh, I'll go back there. You'd think that the banks might actually know what they're talking about because ultimately, when it comes to lending, uh, when when a bank lends you money on a mortgage, right? Especially when they fix it. When a bank lends you money on a mortgage, and it's fixed, what they do is they take a part of their book and they go, okay, $1 million loan, it's fixed for 5 years. What's the fixed 5-year government bond rate that we can get? And they go bang, and they lock that money away. And that's why you have things like break costs when you
yep.
try and break your loan, because if you try and break your loan, then they're going to have to sell that bond.
They got to pass on that cost.
Correct. And if that bond is yielding 5% and the market's paying 6, well, they're going to do some dough, right? They're going to lose some money and they pass that straight back to you. So the banks do this day in, day out, and they're ultimately the market movers and shakers in this. And so where your longer term rates are lower than your short term rates, which means that if your 2-year fixed interest only is at 7% and your 5-year is at 5%, what that means is the banks believe that in 5 years interest rates are going to be lower than what they are right now.
Yep.
That's
That's it.
that's the base to it. Now, this
Yep.
graph that we're looking at here is an annualized. Sorry, is it annualized? It is a little bit longer
Monthly.
than a year. A little bit. It's about a year, right? And this is the 10-year government bond rate in Australia. The 10-year. So this is here June 30. This little dotted line, right? So we can actually see the expectations of interest rate hikes. Just before the end of the financial year, it
Yep.
got to its peak where they were basically saying 10-year money, 4%. That was great because you could actually lock away a 10-year government bond for 4%, which is actually not too bad. It was sort of
Not a bad. Yeah, not bad.
the term for no risk. For no risk, 4%. We hadn't seen that in a long period of time. But what we've seen here is a reasonably substantial drop in that. It almost hit 4.2, and now it's really down at the 3.11. So that's a percent. That's 100 basis points.
Yep.
So when the Reserve Bank says they're raising rates by 50 basis points, that's 0.5%. Right. So what we're talking about is 100 basis points difference between a little bit before the end of the financial year and now the 10-year go. So they're basically saying that they believe long-term rates are lower than short-term. But we've got to then have a look, because that doesn't necessarily mean that rates aren't going up over the next 1 to 2 to 3 to 4 to 5 years, right? Because ultimately rates that we're looking at 10 years. Now let's have a look at a shorter period of time. And you can start to see a similar type of rise. And we're looking at 5-year bond yields now.
Yep.
But also, if we have a look, they're also sort of starting to have little cracks and little dips, which basically is the market saying, well, we actually believe that the 5-year rate is either stabilizing or coming down at the moment. All right. And you can kind of see. So this is the market. This isn't me. This isn't the Reserve Bank. This isn't manipulated markets. This is where the market, which means the banks, businesses around the world, around Australia, that's where the market.
It's the aggregated opinion of what they think that they're hedging their bets on, right, Andy? So it's kind of like, thousands and thousands of hopefully smartish people going, yeah, we think it's about this, right?
Yeah. And if we go to a bank and they lock in a 30-year mortgage, right, and they put some money away, well, they were getting they were borrowing the money at 4%, but now they're borrowing the money at 3.11% for the next 10 years.
Yeah, yeah.
Right? And so this is the commercial terms of trade. And then we go to the 2-year, and 2-year is a lot more volatile and a little bit more range based. Right, so it's not as big as far as from we were talking from 3 to 5. Dummy slides, recognize.
Yeah. Alison, stick with it. Stick with it. The more wine, the easier the connections become. I think actually it's kind of like playing pool, Andy. This stuff. It's like a certain amount of drinks, and you're like, yeah, I'm getting this, and then one drink
Yeah,
too many, and it's like, shit, I've lost it
yeah.
all.
I think I understand it now. But let me try and peel it back. The banks were borrowing money at 4%, which means that if they're borrowing at 4, when they on lend it to you, they've got to make a profit.
Got to make a margin.
Right? Now, that 10-year rate has dropped quite significantly by 1%. And these are major markers. And this is something, guys, we'll keep you up to date with, especially as the media starts to bandy around bullshit. We're going to keep some eyes on some very, very long-term economic trends, which is how our society trades. And ultimately, this is the sort of information that you need to be thinking about, especially if you're a business owner, if you're a property investor, or a share investor, or just you care about where your super's going. These are the kind of conversations that you need to be aware of, probably just to keep you a little bit more comfortable and in the know, because we're looking at Australia, and I guess to summarize what I went through is America not looking great, but looking great for potential opportunities in the not too distant future. Australia presumably was looking terrible, but now the long-term trends as far as interest rates are concerned have stabilized, or at least are pointing in a slightly different direction. And so what we can take a little bit of comfort in so far as the longer-term outlook is that the people who manage the billions and the hundreds of billions of dollars around Australia, their money is in the 10-year space that interest rates are trending down. It still means they're going to go up in the short term, but ultimately that long-term game, and you say it all the time, Jay, so I won't steal your line about investing, but it's long-term, right?
Yeah.
And we're buying for 5, 10, 15 years into the future. And if you just have, that these are the sorts of things that you need to be listening to, so that you don't do your dough by just jumping out at the wrong times.
Mate, dead right. Well, Jeff reckons he'd take $1 million at 3.1%. No problems, Jeff. Well, Jeff, they buy it at 3.1. They've got to on sell it, and it's usually a 2 to 3% like margin on top that they have to put on top of that money to on sell it. So that's kind of you can get rough enough. If they're buying it at 3%, well, it's going to be maybe between 5 and 6%. Like that's kind of the number. So if it's coming down a little, then that's great. In my head, my thoughts, my feel in the market right now, I reckon we'll be between that 5 and 6, maybe even between 4.5 and 5.5. I think that's where it's going to land medium term. That 3 to 5, Andy. Certainly, I think we'll probably get up to 5s and 6s for sure in the short term. But that 4 to 5 is going to be that's my call anyway. There you go, folks. We've got it on record. That's my call. But why don't we? I'll quickly answer this one from Paul. And Paul sort of said, "Hey, listen, what's a reasonable rent increase?" Well, Paul, I don't think reasonable's the right answer, Paul. What is the maximum you could do in the marketplace in the property that you have? You should never do reasonable. You should always do maximum. And Paul, it's not about having a tenant out on the street. It's about making sure you hedge your future risk, Paul, right?
Yeah.
Like Andy and I were talking about right before, Paul, mate, your interest rates could go up every month for the next 2 years, right?
And they're going to. They're going to, well, not maybe 2 years, but they're going to go up probably every month for the next 3 to 4 months.
Yep, absolutely.
And that's straight to your pocket.
Yep, straight out of your pocket. And if you don't kind of maximize now, Paul, which the market will gladly pay, then you're mate, you're turning your business interest, which is a property investment is a small. I call it a micro business. It's a small micro business. You have to treat it like a business. You can't run it at a profit, a loss. You need to run it at a profit. So Mate, I would say I would change it around. It's not about reasonable. It's about the maximum that the market will allow for your quality of real estate in that marketplace. You
And
always should
it's
be maximizing your rents. Yep. Yep.
it's the same thing as the government bond trend, and maybe this is a great way of simplifying it.
Yep.
Is that, if this were the journey, right? If this were, and you knew that this was the journey for your interest rates, right?
Yeah.
Uh, and you're currently paying 3%, but you know that, or likely over the next 12 months, you're going to be up to 4%, and then longer term, it may come down. Well, the question, or what Jace is saying, is you're setting the price here. Now, if you set it at the current rate, you are going to set it, and you are going to lose
That's it.
1%, right? You're going to
Yep.
lose all of this territory here is going to be the cost for you. Now, if you want to be philanthropic to your tenants, that's totally up to you.
You can do it in a much better way, Andy. It can be much more tax effective. If you want to be a charity, there's better ways to do it,
100%.
And like Andy's, Alison's saying here, Andy, that's why you put a property manager in between you and the tenant.
That and that, I guess, it's not my specialty, but I can imagine you get emotionally involved. And the one thing that you kind of want to separate from finance is emotion as best as you can, because you don't want to make important decisions when you're scared, when you're overly happy, when you're drunk, when you've just had a fight. You want to make decisions when you're level and you're dispassionate, and that's when you make the best decisions most of the time.
Yeah, well, Andy, it's an interesting one, and maybe we can put a pin in this one for a discussion in another time. But folks, the best thing you can do is to look after yourself really well, right? Everyone sort of nods and goes, yeah, I get it. You go, oh, look after your health, Andy, because if you're not healthy, you can't look after anyone else, right? And you go, oh, look after your, I don't know, what your mental health or your physical health or whatever. And then when it comes to like, Andy, look after your money, because if you don't look after you first, you can't look after anyone else. And then it becomes weird, this discussion about, oh, what? Hang on, because I'm looking after me first financially, I become this, tyrant or this asshole that's a capitalist or whatever. No, folks, that's completely irrelevant. If you make a profit, then you can go give it to charity if you like, but don't lose money. Don't waste your life losing money because you want to look after someone. It's not the sequence to do it in, is all I'm saying. So that's that's the conversation. So yeah, I agree with you, Andy. There you go. Well, folks, mate, we might put a pin in that one, but why don't we make sure we let everyone know we've got a guest next week?
We will. I think we said we'd answer the questions. I think there was one about inflation, 2 to 3% target. I'll answer it in 30 seconds.
Yeah. Wax lyrical on that one.
And just see if there's any other questions, because I know that we always say get them in, so it'd be amiss if we don't answer them. But what's the fascination between 2 to 3% target inflation? So every single reserve bank equivalent in the world, the Federal Reserve, the central banks of the world, they all of the ones that I know about, so most of them, there might be a few that I'm not aware of, they target inflation, right? Which is the costs of goods rising. Now, in Australia, that band has been between 2 and 4%. That was brought back to 2 and 3%. But ultimately, Andrew, it's if the cost of goods go up too quickly, we end up like what Brazil was like and what Thailand was like, where all of a sudden you start writing extra zeros or crossing them out on
you
dollar
have a
bills.
$1 trillion note, which is worth nothing.
$1 trillion note. And it becomes completely unmanageable, and the wealth divide between the wealthy and the haves and the have-nots becomes very. The gap accelerates quite dramatically. And if you have a look at Brazil, and if you have a look at Thailand, and you have a look at places like that, because if you're on the right side of inflation when it's taking off, then it's incredible and you make a lot of money. If you're on the wrong side, then you lose your pants, you lose your seat. It also goes for the stability of trade. Right? Because ultimately, if a currency is accelerating in value too much up in the upward direction or decelerating, then countries don't want to trade with you. They don't want to buy
Yeah.
your resources
You're
because it's
too
like
volatile. Yeah.
you're too volatile. They might
Yeah.
pay, $1 billion today, and then they'll only get, $500 million worth of goods. So this inflation target has been set, and this is what I think we talked about it last week. Have a look at the right hand while we go and fuck the economy on the left, which is the
Yeah.
politicians of the world. They're going, oh, the RBA, it's all wrong, and blah, blah, blah. It's bullshit. The management of the company, the fiscal policy is really poor. The monetary policy probably needs to be evaluated. And I agree. I think that potentially an inflation-only target may not be the right maxim for the future. It's done us very well to now, but I think we do need to start to think about it. But what they're doing right now is they're going, look at the RBA while we destroy the economy over here. They should be, when it comes, it's just a business, Andrew, and a business is, you don't fire the CFO of a business because the company's losing money because you're not getting enough sales. You fire the CEO and you fire the salespeople.
The salespeople, yeah. It's not the
CFO is
accountant's
just
fault.
reporting on it. It's the CFO is just telling you what is actually happening. And at the moment, you've got the CEO of Australia going, "Oh, the CFO's doing it all wrong over here. They're not quite getting it right." And so let's go and have the conversation. The reality is that the government's shitting the bed, and they have been doing it for quite some time. And they're trying to go that the CFO's calculations are incorrect. And that's probably the best way I can put it.
Mate, that's actually gold. We've got to write that down. I'm going to capture that. Hey, I'm fine with my CFO because they're telling me something I don't want to hear.
Out with the CFO. Get out.
Come on, mate. I need someone to tell me what I want to hear. But there you go.
You're doing great.
Well, it's dead right, Jace. Bad wealth can lead to bad mental health. Like, folks, you got to take care of yourself and your financial well-being first before you bestow, if you've got the capacity, to others. And I think that's that's an important thing to really acknowledge and understand. So at the end of the day, mate, there's plenty of dimensions to our health, and wealth is one of them. That is for sure. So there you go. Happy days. So, bit of a shout out to James. Looks like he might be on the beers. Good to see you, James. And listen, folks, I think we'll call that one, Andy. What do you reckon? We'll call it. But next week, Andy, we have a very special guest. Now, this is not hot air and sunshine. This is for reals.
I'm actually going to go back and just make sure he's accepted the
make sure he's locked in, Andy. Yep. But matching beards. Hey, actually. I actually got to get myself a haircut and have a shave, folks. So next week I'll be a little bit slicker than I am this week. I'm a bit rubbish. But anyway, Andy, who we got on next week? So give us the 30-second headline of who we can expect next week as a guest.
Malcolm Palmer is one of my advisors when it comes to all things economics, all things stocks, both domestically and internationally. He comes from a family lineage that his granddad actually set up the Sydney Stock Exchange.
Wow!
And he is now the CEO and also the chief investment officer of this company, which has been around since the gold rush days. So he's just a beast when it comes to markets. Understands it's very, very simple in his approach to things. He's not sensationalist. He doesn't try and outsmart people. He just really brings it back down to the brass tacks. And so Malcolm Palmer's his name. Joseph Palmer and Sons is the business, and he's going to be joining us for a bit of a wealth chat. So, ladies and gents, if you've got any questions about global markets, economics, he's very learned when it comes to geopolitical issues. So write down your questions. It'll be an incredible session. And get ready. I'm sure that he'll have his little stock charts and stuff like that ready to rock and roll. And I can't wait, mate. I love chatting with him. My clients will see him with a reasonable degree of frequency in our members' sites, and they all love him as well, because I think that the smartest people in the world quite often have a capacity when they've got some empathy, to be able to simplify things so that it was Einstein who said, if you can't explain it to a 3-year-old, then you don't understand it yourself. And Malcolm's one of these people who really understands it at a level that he can help us, be able to digest it and be able to make decisions and feel comfortable in what we do. So that's a little bit longer than 30 seconds.
Bit longer. Yeah. Well, mate, I've listened into a couple of your live streams with him, and yeah, I've learnt a significant amount. It reminds me of something like, if you're the smartest person in the room, you're certainly in trouble. You know what I mean? So, folks, we're going to get someone a lot smarter than me and Andy on next week, and certainly look forward to learning with you guys a little bit about all things in that space. But, mate, I think that's us. We're done and dusted, folks. Well. I think it's fabulous Friday. You guys be awesome. Be well. Have a great. Can we do that, Andy? Like, ready? This way.
Yep. That's it.
All right, folks. You guys be great. Have an awesome weekend, and I think that's it. It's a good night from him,
and it's a good night from me. Good night, everyone.
Good night. See you, folks.